Good morning. Thank you for coming along this morning. My name is Jodie. I'm running the session today. So we've got a protection planning case that I'm going to build out. I think everybody should automatically be on mute. If you do have any questions, please do pop them. There's a questions box and a chat box, and I'll stop at intervals just to check any questions that come in and answer as we go along. If we don't manage to get through all of the questions during the session, someone will reach out following this morning and make sure you have no unanswered questions. I'll make a start. It's 10 o'clock now. There probably will be a couple more trickling in. But yeah, I'll make a start. So the session that we're looking at today, we've got 4 different forecasts. We're assuming one where a client has no protection and is a picture of perfect health and everything's fine. We're then going to model what if they couldn't work from, say, 5 years time. So we've got a young client, age 40. So what if they can't work from 45 onwards? We'll then go into a case where there is some basic level of cover there and see the effects of that. And the final forecast, we'll look at a more comprehensive cover and plan for if disaster did happen. So I'm going to jump straight into CashCalc. Before we go into the actual cash flow modelling part of this, there are some elements within CashCalc that exist to assist in protection planning outside of the actual cash flow. So if I hop over to the client portal, so I'm currently logged in as the client in the portal, so everything you're seeing on this screen now is what the client would see if they've been invited to complete a fact find or you've shared documents with them. So this is set up from within the advisor side. You can invite the client to the portal. You would do that by simply clicking on the client in question, going to the onboarding tab and selecting invite to client portal. Now this client does already have a portal account, so those buttons don't exist, but once the client is onboarded, you do get an activity log. You can see date and time stamped records of when the client has logged in, updated information, viewed a document, agreed to a document. So big compliance tick on the portal activity. But here we have the client fact find. So this is already part populated, and that may be because I've brought that client in from my back office system and that information is part populated. It might be that I've looked after them for a number of years and it's just remembering previous information from the last fact find at the last annual review. But we'll work our way through it. The client does have a daughter. She's currently aged 8. And the client works as an engineer at GE. They have a salary of £60,000 per annum, and their expenses have been added. We've got essential spending and then lifestyle spending on top of that. They are steadily accumulating wealth. Their pension currently has £50,000 in it, but they do also have an ISA and some cash as well. Now, where the system will mention things related to protection, we've got a very short questionnaire in terms of the client's current state of health and whether or not they require or have a will, power of attorney. We have that here. Now, the next page will then take you to an indicative quote, or take the client, should I say, to an indicative quote. This is an integration that we have with iPipeline. So it is giving an indicative quote for life insurance. In this case, £47 per month could provide the client with £100,000 payable on death if they were to pass away within the next 20 years. So we have that. Another part of the system, it's only a small feature, but it gets quite nice feedback. So we have, if in a fact find the client tells the system that they have a dependent but they don't have a will or they don't have any life insurance, the system will build in a prompt for an objective. So in this case, we've had both of those pop up. You've got a child and no will. Do you want to speak to your advisor about that? you have a child and or a dependent and no life insurance. So you can quickly build in those objectives in the fact find there. So that can then be reviewed by the client and then sent back to the advisor. And there are other features within the portal that clients would engage with, i.e. you can send documents. They can also send documents back to you. Everything on the portal is encrypted, both in transit and at rest. So it is a safer environment to be sharing sensitive information compared to the likes of emails, for example. So if I hop back in as the advisor now, and I'm just going to refresh my page, we now have some added activity in the log here, and we've also got a couple of notifications at the top. So here we have all of the notifications here. So if I view these notifications, we have that fact find that is complete and ready for review. It's been sent back to me as the advisor. And if I go into this, it will only give me the changes. So appreciate I just showed you that there was a pension, an ISA, some cash savings, a salary, but that information already existed in CashCalc, so it's not going to ask you to review that again. These are the two information points. You can click into them just to see in a bit more detail, and we've got two objectives: discussing a will and discussing life insurance. When we save a fact find, it updates the information that is housed in this client information tab. Over the years that you look after a client, you may end up with 20, 30, 40 fact finds. Each one would be date and time stamped with the point in which it was closed off, saved and reviewed. But the client information page will only contain the most recent data. So if we work our way over the different tabs along the top here, we have a brief overview where we're capturing all of this, the personal details information. The servicing tab acts almost like a diary of things that you can keep tabs on for a client. So any records of recent conversations, you can pop them here, and this isn't going to go back to the fact find for clients to see. So this is really for you to keep a track of things and pop your own notes in. If the client completes an ATRQ, the details of the results would sit here. We then have ISA, cash savings, pension, property, details of any liabilities, mortgages, etc. would sit here if we had them, but in this case we don't. And then we have their salary and expenses, and those objectives sit at the very end there as well. So now that we've got this information in CashCalc, we can now push it over to a cash flow forecast. So in this case, we are using the gross modeler. For those of you that have used CashCalc for some time, you'll be well aware of the net modeler. So this is where CashCalc started. A bit of a manual process in terms of cash flow modeling, i.e. you would need to calculate the net figures on input compared to the gross, where we might ask for a bit more detail, but that's because the system's going to tax everything for you. I am creating a new forecast, and I will call it current situation. Full health. We can then see all of the different inputs that are going to send over to the cash flow plan. If for any reason we wanted to take any of those out, we can just untoggle them, but I do want to send everything over, so we'll send that. So now that we are in the cash flow modeler, my advice really to everybody using the system is just to work your way down each of these tabs on the left-hand side, and you're not going to miss anything. So starting in the assumptions tab, we have some assumptions on inflation, CPI, RPI, and we also have this surplus income to save. Essentially what this does, if ever there is a point in the client's life where their expenditure is lower than their incomes, then the system by default will accrue all of that surplus, and you can choose which pot you want to accrue that in. Bear with me. Back here. There we go. So you can choose which pot you'd like to accrue that money in. A couple of things the system will do, if you are contributing into a pension and it is above the standard £20,000 per annum contribution allowance, the system will flag up a notification to say you've got a lot going into the ISA, have a look at it. And if we are contributing any surplus cash to a pension, it will treat it as a personal contribution and it will gross up for tax relief. In this case, the client is contributing to their ISA, but they have a set value amount there, and any surplus above that is not to be saved or accrued in any of their savings pots. So people and timeline. Of course, if you are based in Scotland, be sure to change this. We'll do the right taxes. The timeline at the bottom here, this is going to be particularly useful for this example case. When we come to the client's salary, their life insurance payout, their life insurance premiums, all of these things, their protection premiums, we're going to link that to an event on the timeline, and then we'll be able to move that and see the effects of them being unable to work from, say, 45. So if I just drop other on here, let's drop other up here, and we'll just say end of work. It's really useful for retirement planning as well, i.e. if a client knows when they want to retire, it could still change. So you can link things like their salary, work-related expenses, pension contributions, drawdown to either start or finish at the point of retirement. And then in order to see the effects of a different retirement age, it's a simple case of dragging the slider up and down the timeline. Savings and investments, the system will pull through the information that it has. So in my client information page that we were looking at a moment ago, I did put the details, the growth rate details in against the ISA. But if you've not got that information populated in the client information page, I would definitely recommend checking in on these pots as you work through the cash flow plan, just to ensure that there is some growth applied to the ones that need it. So if I click edit next to this ISA, we have a couple of different options where growth is concerned. We can either pop in a linear return, i.e. 5% in this case. Alternatively, we do have variable growth templates, and I am going to apply one of those to the pensions so you can see those in a bit more detail. You'll also notice that we have the different wrapper types in here. So onshore, offshore bonds, we will capture a chargeable event for any withdrawals made in the future. GIAs, we will capture CGT if a GIA is either planned, there are planned withdrawals coming out of it, and or it's used to cover a shortfall at a later date. If we move down to the pensions tab, we have the G pension, which has come in. If I click edit next to this, this is a good example, I suppose, of where we're asking for a bit more detail compared to the net modeler. So if a pension is to be tax-free because it's inherited, you can select that option. And we also do need to know whether a pot is fully uncrystallized. If it is not fully uncrystallized, we just need that uncrystallized pot value to ensure they get the right amount of tax-free cash later. In this case, client is age 40, it is an uncrystallized pension pot. So looking at these variable growth templates now. There are a few that you'll see built into the system already. Some of these example benchmarks are quite popular. So this is using IA sector data. In this case, the client is a cautious investor. So if you were a cautious investor between the years of 1990 and 2024, this will add 2025 in as the year finishes. This is the sort of growth that you'd have got. So though the average is 5.23, we are assuming volatility. We have very recently, this week, gone live with DB pensions. For anybody that's used the system for a while, I'm sure you've added in a DB pension as an income and just had to call it DB income, but we do now have this functionality available and more automation in this space. I do have to say the amount of development that has gone into the gross cash flow over the course of this year is really impressive. We've had quite a lot of releases, and this is our latest. In this case, the client does not have a DB scheme, so I'm not going to go into that now, but I'm sure we'll have some materials being shared around at a later point. Can add the state pension in, which will use today's value, and it also knows when the client should start receiving that. If, of course, they're in receipt of a lower amount or they're likely to get a different figure, you can just change it. One of the other developments we had go live this year is the introduction of salary sacrifice pension contributions. So we have this salary here. If I click edit into this, it is employment, should be taxed as employment. We have a gross salary of £60,000 per annum. We can pop in any details of bonuses or benefits in kind, company cars, etc. But the thing that I want to ensure I'm doing here is linking this end age not to age 68, rather the actual event for work ending. So if you've got any events on the timeline and you want to link an input to that, it will sit at the top of the scroll bar. And at the bottom here, we can now include pension contributions from the salary. So if I click into that, we can choose either DC or DB. In this case, it is DC. Going into the GE pension via salary sacrifice, and the client is contributing 6% of their salary per annum. You can pop in any details of the NI savings if that is relevant. In this case, it's not for this particular client, but the employer is also matching that 6% as well. So we can add those in. Adding that detail at the income level has now created my pension contributions for me. So these have just been auto-generated. And when we come to look at some of the outputs, I'll be able to show you how we've adjusted the taxable income, etc., for salary sacrifice. Expenses, I don't need to change anything here. I've pulled those through from the onboarding process. But if you have any other expenses to add, you can just add expense. We need the name of the expense, the amount, frequency, and when it should start and finish. Transfers, not relevant for this particular forecast, but another feature that we went live with this year. This is particularly useful for bed and ISA, bed and pension, transfers between spouses, and pension consolidation. So essentially, the way it works, you just choose which pot you are transferring from, choose the pot you are transferring to, give it a name and a frequency and all of that stuff. You can also then select whether this should be a tax-free transfer, relevant for any pension activity. and then and whether or not it should happen before any other withdrawals in any given year. In terms of the calculations in the background, it works as if you were if I was to add this in, the system would make a withdrawal from the ISA and then a contribution to the emergency fund. So that's how it works in the background. I have my pension contributions, but the client is also contributing to their ISA. So let's add that in. Now the contributions in CashCalc, you have two types, either a personal contribution or an employer external source contribution. Personal contributions are money coming from the current account going to the chosen pot, which is what this is in this case. And the client is putting £500 per month, which realistically is probably going to stop at the point of ending work. I'm not going to add any withdrawals in. The system does take money from the pots if ever there's a shortfall, and it'll do so in a liquidation order. You can set the liquidation order yourself. You can either do that in the savings and investments tab or the pensions tab. It takes you to the exact same place. But in this case, the only switch I'll make is I'll put the cash savings at the very bottom in this case, but it's just a pick it up and drag and drop. And we can just update that liquidation order. I'm going to add a charge in. Let's add this in on the pension. You can split your charges out. You can have your fund platform advisor fees all in separate lines, but I'm just going to group everything together and just put that in at 1%. And this would run indefinitely until the end of the forecast. So I'm just going to run through my inputs and just make sure that I've added everything correctly. I'm not expecting any surprises when I look at the outputs. So we've got end of work age 67, growth on the relevant pots, pension, state pension, salary running until the end of work, expenses running indefinitely, no transfers, and 3 contributions and some charges on the pension. So I'm happy with all of my inputs there. And before we look at the outputs, I've got a couple of questions in the chat box, so bear with me, I'll just check in on those. So we've had a question, is there a way to change the default? So the default on the surplus income to save is £0 as opposed to 100%. I think the surplus, okay, so this kind of depends on a few different factors. So we have recently released enterprise controls, which enables larger groups with some settings to set assumptions and have that filter through, so everybody is working within the same parameters. So if you are excuse me, if you are in a group, there could be some assumptions that have been set at a certain level. What we'll do, I'll make a note, because this is kind of a different answer depending on your setup. So I'll make a note and be sure to reach out. Yeah. So another question we have is, what is the benefit in putting the pension consolidations in the transfers instead of just adding a new pension detail in the accounts tab? Does it show the customer pre and post transfer growth rates and fees or anything? So I suppose just the benefit of building it in the transfers would be if it's not something that's going to be happening immediately. So if this pension consolidation exercise is something that might happen in a couple of years' time, you can have the current setup built and then you can have the transfer. The other thing is as well is if you have a pension, you have a client with 4 pensions, but they actually can't transfer one of them for a certain amount of years, you can have them happening at different points. But I suppose the main benefit really is just on the reporting side of things, the transfer is clearly outlined. But I completely appreciate what you're saying. You could have one forecast where they don't transfer, and then in your other forecast you've just built one consolidated pension pot, and you have those bases for comparison in that way. Both work. You just have the transfer is more visible in the report at the end of it, I guess, if you've used the transfer functionality. So it's quite a lot of questions. If clients divorce, is there an easy way of splitting them on the system? So at the moment, it is a bit of work to split them. Yeah, so a client record in CashCalc, for obvious reasons, if you have a client record where it's a joint couple, a joint account, getting some of that information out into a different account is extremely hard, and it's all for GDPR purposes and keeping data safe. So you can't sort of lift and shift information out and move it to another client record. So it would be a bit of a manual process. It's absolutely possible, but there isn't, a button that says, separate these clients out into two separate records. Okay, so I'll come back to some more questions at the end. I'm just conscious of time, so I will try and work my way through all of them. So let's have a look at the outputs. So in this case, pretty much exactly as the client predicted, if they were to live a healthy life and be able to work right through until age 60, 67, 68, they're probably going to be okay. It's quite a healthy looking cash flow forecast. We have some solid growth on the ISA over the years the client is working. This is then the first used to cover any shortfall and be spent during their 70s and 80s. And then the pension is sitting on top of that. So we have 3 graphs. The first graph, the savings over time, we're looking at the different pots here. So each different colour represents a different one of their savings pots. You can hide all of them and just hone in on one at a time. And yeah, also you can see there's the variable growth that we've applied on that pension there. You can see the volatility in there. We'll add all those back in and hop to the other graph. So the other graph, we have the money in versus money out. This is the cash flow in and out of the client's current account. So we have in blue their salary, which if I hover over that, we can see it's been taxed down, so their 60k salary is looking more like 43 net. We then have their expenses in the represented by the black line, state pension later on, and anything in a pastel shade is where there is a shortfall, and CashCalc hasn't been told where this money is being met, so it's looking at the pot liquidation order. So it's taking money out of the ISA initially, and then it's moving on to the pension. And another default built within the system is where it can, it will take UFPLS if a pension is used to cover shortfall. Now, if you wanted to override that, or you added into a forecast a PCLS withdrawal, of course it will flip over to Flexi Access. But if it can take UFPLS, that's the default it'll try for first. If you wanted to change that, you would just go to your withdrawals tab on the inputs here and then specify, well, they're actually taking PCLS in whichever year, and it would, yeah, you can build it out in there. The third graph we have is the taxes graph. So this will capture national insurance, income tax, and capital gains. The yearly breakdown is just the numbers that we've used to create the graphs themselves. So if I click into any given year, it'll break things down and show you how we've calculated things, particularly useful for the income side of things. So in this case, clients' gross salary, we're then deducting those employee pension contributions. So we've got an adjusted taxable earning here. And then we are adding in, at the bottom, you can see exactly which portions of this salary fall into which tax band and how much tax is paid in which bracket. Money out is their expenses, and liquid assets here is where you would come if you wanted to see the nominal effect of a withdrawal or a charge. It will give you anything you've added as a percentage. You can find the numbers related to that in here. And you can also see how things like inflation, growth, charges, etc. have affected one specific pot in any given year. So in this forecast, our first forecast, we are assuming full health, client can work until retirement, and everything looks okay. So if we go to the top now, we can clone this forecast. This will be forecast 2, no, sorry, 2, and unable to work 45. So at the bottom here, we can clone any existing forecasts. So we'll add that in. There are now 2 forecasts sitting at the top, so ensuring that we are in this new clone that I've just created. And thanks to me linking all of my incomes to this event for work ending, as well as my contributions, all of that stuff, I've linked it all to the event. The only thing I need to do in order to see the effects of being unable to work from 5 years' time is move the event for that. So if I just jump back to the income now, we can see end of work is now 45. The contributions, they're all finishing at 45 as well, and everything else remains the same. So if we hop over to the cash flow model, the graphs, the taxes, we can clearly see that they're only taxing the working period. But if we look at the not a great picture. So the reason why in this instance we have both a shortfall, a deficit sort of racking up in the current account whilst also having assets available is that the pension access age is set at 55. So we have this period of time where the client's unable to work, their ISA has all been spent, and they can't access the pension just yet in this forecast, hence why there's both deficit and assets in the same years. So that is our second forecast. This, I suppose, would be a sort of real doomsday worst case scenario forecast. But if I click to clone again, and in this case, we've got forecast basic cover. I'm going to choose to clone now my second forecast, being unable to work from 45. To add in the details of the cover, we can go to our inputs again. There are a couple of things we need to add. I firstly need to add in the expense for the premiums. So let's say basic cover premiums. And let's say this is £25 per month. And we would run that until end of work. Add that expense in. And for this particular policy, it's going to give them a, let's say, £60,000 payout at the point of being unable to work. And there are a couple of ways that you could add this in. So for forecast 3, we'll add it in as an income. For forecast 4, we'll do something a little bit different that I'll explain in a bit more detail. So if we go to the incomes now and add that in, it is not employment, we'll say it's other, and we'll just call this NI payout. This would be a one-off. We can then select tax or taxable, so non-taxable in this instance, and it would pay out at the point of being unable to work. And for anything that you add that is happening in the future, you might notice an extra box pop out, and this is just asking, does that need to be linked to inflation between now and the point of it happening? Should it inflate? In this case, I'll say yes. If it's not, and it's sort of the quote of £60,000 payout is level, regardless of when it happens, you can of course untick that box, and what you'll see is that figure decrease. Essentially, the whole of CashCalc is built to be in real terms. Yeah, so add that in. So if we hop over to the cash flow model plan now, we do have this extra life insurance payout that comes in. It's not really making a huge amount of difference in this case. Being unable to work from age 45 is obviously quite a drastic thing to happen. So my last and final forecast, we've got forecast for the first forecast is pretty much always going to take the longest to do, just to make sure you've got everything right. But once you have got that first forecast created and everything is linked as it should be, it makes all of the other forecasts just very quick to pull together. So in this instance, we're looking at a more comprehensive cover for the client. So if I go to the expenses, the first thing I need to do is change the level of the premiums. So in this case, we're looking at £120,000 per month. And this cover is inclusive of both income protection as well as a larger lump sum payout. So in terms of the income protection, we could delete this, but I'm just going to edit it. So income protection of 2,500, which would be per month. And we would want this to start at the point of the work ending and run, let's say we'll run that until retirement. And then again at the bottom here we have these inputs for the different inflation. Okay, add that in. And the other thing we're going to do is build in this lump sum, but we're assuming this lump sum is actually going to land in a GIA or another wrapper rather than in the client's current account. So one thing to note, if you're adding in an income, the system is assuming that money is always landing in the current account and is therefore the first thing to be used to cover expenditure. So if any lump sum or any cash is coming in really and going to another pot, I would recommend adding that in as a contribution. But if I go to my savings and investments, I'm going to add in a fresh pot at the start, and we'll call this payout pot. We'll say it's a GIA, and the original sum invested is £0, and the starting pot value is £0. They don't have this money yet. We're just setting up the pot. It's going to sit empty for a few years. Once that money does come in, it is going to be invested in line with the same risk profile that the client is. So we'll put them in cautious, and we'll update that pot. The other thing I would want or the client would want to do is when this money does come in, it will actually be the first pot used to cover any shortfall. So I'm going to drag that to the top of my liquidation list. And the last thing to do here is just to add in the actual payout itself. Payout, and ensuring that this is now an external source contribution. It's not money coming from the client's current account. It will be for the value of 150,000. It would be a one-off and would happen at the point of work ending. So if we add that contribution in, what's going on there? Seem to be having some issues with adding that contribution. Not really sure what's going on there. But if we, in which case, let's add that as an income. Okay, so if we look at the cash flow model now, a more comprehensive cover. Appreciate it's not. We are also assuming the client's expenditure is just remaining exactly the same throughout all of these forecasts. So it is an improved situation, and that is the final forecast. So there are loads of questions. So bear with me. I'm going to work my way through some of these questions. Hang tight. Okay. Okay, so I think I've answered the one regarding is there a way to change the default to 0% rather than 100% where the surplus income to save is concerned. If I just go to my settings and go to flow. Yes, Ian, so sorry, you can go to your settings and you can go to the cash flow plan, the cash flow tab on the side, and surplus income to save is one of these options here. So you can save that as a new surplus. What I will say, however, is if you're part of a group and some settings have been set at group level, you may not be able to change this on your account, but yes, it can be changed. I think I covered off the benefits of using the transfer feature compared to just building a forecast where all pots are consolidated. So the next question, I don't know the answer straight off the top of my head, so let's build it out and work it out. So what the question is, if you do a transfer from an ISA to a personal pension, will it gross up the contribution into the pension, i.e. take £8,000 from an ISA plus the 20% income tax when it enters the pension, so will £10,000 go into the pension? So let's build it and see. Bear with me. So if we have a transfer and we are transferring from the ISA to a pension, let's just call this test, and let's say we are putting, let's go with 5,000 as a one-off. Let's do it next year. Add that transfer. If I hop over to the yearly breakdown and look at this year, seem to be having some issues with the system. Okay, there we go. Right. Transfer from the ISA to the pension at age 41. Let's ISA, okay, transfer out, transfer in, additional tax relief at source. Yes, yes, it does. Yeah, so if you build in anything like that, I recommend any sort of questions like this, the best place to have a look is then going to be in the yearly breakdown section where you can see the numbers and what we're doing in the background. So yeah, in this case, you'll see transfers out and transfers in, and then any additional relevant information would sit in there as well. So I'm happy to keep going through, working through these questions live on the call, but I appreciate the session is a 45-minute session. So for anybody that does need to go, please feel free, I won't be offended. Thanks again for coming along, and I hope everybody has a lovely rest of your day. I'm just going to work my way through the questions, so feel free to hang around and listen at that as well. So if a client was to pass away and you wanted to essentially remove one half of a joint client from the forecasting going forward, if I go to my list of clients, I likely have a joint client. I do here. So the cash flow model is going to remain. So okay, so if we have just a quick look at this cash flow model. So we have a couple of different inputs. We've got some jointly owned things, some things owned by one client, some things owned by another. If we wanted to remove one of the clients, it would be a case of going to the client record itself, clicking edit, and then you can remove. If it was the other one, you would just need to pop the one that's, so we could just say yeah. Let's put 65. There we go. Oh, sorry, I didn't get right. Untick the box and then ticked it again. There we go. So if we update that there, in terms of the cash flow is, I believe, still going to have all of the information that it had. So it would then just be a case of tidying up the next cash flow to accommodate for. So a person has been removed from this forecast, you may need to update the existing inputs to reflect it. So we will see the inputs in here, but rather than having to create an entire new client record and have the client complete a new fact find or create a new portal account, etc., all of that now is transferred over to the surviving partner. But you will have to, fix up the cash flow itself. Okay. Can you show how to model the movement of a drawdown pension from one spouse to another on death? So the way I would recommend doing that would be if I let's add the second partner back in. So I would make use of the timeline. So we do have mortality in as a timeline event. If you wanted to call it something else, then you absolutely could just drop other on the events timeline. But I would link everything to that event, i.e. if you've got a client with a DB pension who's I don't know, was a police officer, and on death their partner is going to receive 50% of that DB going forward, you can add all of that. You can add the full value until and you can have this sitting right at the end for the vast majority of for your initial forecast. And you can have the full value of that DB running right up until 97 in this case, and then have a second one from that point above for half the value, and then it would just be a case of dragging it up and down. And the same really applies for any drawdown. I would use the transfers tab. If I create a new forecast, yeah, it would be a case of using the transfers tab and transferring it into another pot, being owned by the surviving partner. When setting liquidation order for withdrawals, can you set limits within the order, i.e. pension first, but just up to the basic rate threshold, and then move on to the ISA? I'm afraid not. That's a really good idea, though. So I'm going to, I'll have a chat this side and see if that's something that we could build in. Essentially, we have on the withdrawals side of things, if you want to cap the amount, or you want to be specific about the amount being withdrawn in any one given year, we have that functionality available via the withdrawals tab. You know, you can go in and you can say, for the first 10 years of retirement, the client is taking £7,000 per annum from the ISA, and everything above that is then topped up using the liquidation order and taking UFPLS from pension, for example. So we do kind of have the ability to accommodate limits like that, but it's not specifically at the liquidation order stage. If we're taking pension income via UFPLS, do we need to change the pension effective rate of tax to 15% to allow for no lump sum for a basic rate taxpayer, or do we leave the default rate at 20% and the system works it out? So in the gross cash flow modeler, you don't input any tax rates. The system does that for you in the background. So you know, at the pension level, there is no growth. There is no tax rate that you input. I'm not sure if this is relating to the net modeler. So if I just hop quickly into a net forecast just to show you the difference. So if we go to cash flow and net basis, so we have the gross ones here and we have the net basis here. If you were to add in a pension on the net modeler, it looks slightly different. So let's put that there. As soon as you click this pot is a pension, the system will ask you if it's used to cover a shortfall, what tax rate would you want to apply? And for UFPLS, yes, 15% is what we would see if you were using the net modeler and doing it this way. So yes, but in the gross modeler, you don't have to do any of that. The system kind of does it all in the background for you. Okay, so if you have previously used the net modeler and want to move on to using the gross, there is a quicker way of getting that information. So if you've not onboarded a client using the client portal or anything like that, and you've just built those forecasts directly in the cash flow plan itself, you can go. So let me just add something in here so we have something that I can show. Let's say we have that, and that's the one off there, add expense. Okay, so we have a forecast with something in it. If I go to the client information page, at the top of the page, we have the ability to fetch updates, and you can choose to fetch from the cash flow modeler. It will only fetch from, no, it gives you everything that it wants to fetch. So you choose what you can choose which forecast. Sorry, it will only choose from the net modeler. But it's found at the bottom here, we've got an expense that exists in that cash flow that is not in the client information page. If you then confirm the updates, it will populate this page, and then you can go on to update a calculator and push it to the gross instead. So it does only work that way around. A lot of the inputs are incompatible. Transferring from gross to net, i.e. in the gross we're asking for a salary, we're asking, is it an earned income? Is it taxable? Should it be taxed as a dividend? What's the escalation rate? Is there any pension contributions attached to that? And in the net modeler, we're asking, what's the name of the income? How much is it? When does it start and finish? So they're not really transferable inputs, but you can get the net into the client information and then push that to the gross. You would then just need to fill in the extra bits that are required for the gross to tax things correctly, basically. Yes, we record the session and it'll be sent out. I don't think I've ever had this many questions on a on a Wednesday session. This is great. Okay, let's have a look. And the pension access points, if they can't work, they may qualify for early access. Yes, you can. So if we go back in here, oh, sorry, it is. So the forecast assumptions. So if we go to forecast assumptions, where is it? It is somewhere. I'm just having trouble locating it. Okay, if there's a shortfall in income, liquid assets will be drawn to cover. If this option selected, DC pensions won't be used. There is in settings. I'm not sure. I'm not sure there is actually. I don't think the system will allow pensions to be used sooner. I'm going to do some more digging and come back on that one. Yeah, so someone's pointed out that the premiums shouldn't be increasing with CPI. You can absolutely, on any expense that you add into a forecast, you can select the different inflation rate or not inflation rate. So you can choose a custom or you can not increase with inflation. If you're not increasing with inflation, this figure will actually go down over the years. So as we're in real terms, we're looking at buying power really as opposed to nominal value throughout. So yeah, that expense shouldn't have been linked to CPI. Yes, another recording question. We can do that one. Would it be possible to link the payment to an event rather than a set age so you can adjust it with yeah, absolutely. So anything that you add in the system that requires an input for when it should happen, it's up to you to choose whether you link that to an age or an event. The events all exist at the top of the list. So yeah, absolutely. Okay, so somebody's asking about survivor analysis, I guess. So it should have a function on married client death where all assets can pass to the surviving partner and the system shows under 25 inherited pension tax treatment. It is coming. It is coming. The development plans, one of the key focuses going into next year is bringing IHT functionality into the gross cash flow modeler. There will be a series of different bits that will come live before that in order for it to work, basically. So things like bringing properties into the cash flow plan, we don't currently have a slick way of doing that. So that'll be something that comes, as well as survivor analysis in exactly as you've just mentioned there. So this is all in the roadmap and on the way. The reason why I chose to use the gross cash flow modeler is just that this is the forecaster that is being added to. We've had a few features go live during the course of this year. In terms of functionality, you know, they're both cash flow modelers. They both do the same things, and the conversations I have with firms using CashCalc, it really does vary case by case as to whether someone uses the net versus the gross. The gross is just the one that I chose to use today. For, you know, simple cases, you may find that the net is actually the better forecast to use. I just like all the extra bells and whistles the gross has. That's that. Can you change the growth rate post-retirement? So they may be a higher risk investor during the earlier parts of their lives and then be a bit more risk adverse later on. So there is, at the moment, no. It's again, it's something being reviewed, but it would be a case of essentially transferring the pension into a lower rate pot. So if you just had, you know, pre-retirement pension pot, post-retirement pension pot, and you have an adventurous investor initially and a more cautious one later on, you could just transfer that 100% of the pot value at the point of retirement and move it over. That would be the way to do that. So the question about ISAs being transferred to spouse on first death, at the moment, no. Again, this survivor analysis stuff is all sort of in the works. You would need to manually build the ISA being transferred over on death. Thank you. The pension access age is editable under people and timeline. I knew we had it, I couldn't find it, it's there. So the pension access age, you can change it. Thank you so much. Yeah, thank you. Excellent. Okay, I think I've managed to get through all of the pensions, all of the questions. Yeah. Thank you so much. Thank you for all the questions. It's nice to have such engagement in one session. Yeah, have a lovely rest of your day. And for anything that is, if anything has been missed, please do reach out. We'll go through the questions again just to make sure that we did cover everything. But yeah, have a lovely rest of your day and take care. Bye.